All right, welcome everyone. This is SeeWing Yee from the Yee Real Estate Network, and I have once again our guest speaker, Mr. Richard Advani from Supreme Lending, investment loan agent who does investment loans in all 50 states. His company also does owner-occupied loans as well, especially for investors in California. Richard is based in beautiful Southern California, and he has having a great time living down there. I wish I could live down there as well, but I do live in the San Francisco Bay Area for the past 30 years myself. But he and I, we understand investors that buy investment properties all over the country, cash flow properties, and we mutually work with each other quite often over the years, and we work as a team to use his financing strategies to help investors to leverage and build their wealth to achieve people's financial dreams. So without further ado, the presentation today, it'll be very, very unique. It's sort of one of my blueprint formula, which I have established. So here's the agenda. The agenda is I'm going to use a sample investment property. Usually everything's hypothetical, right? I mean, every investors have different goals and objectives. But here's the hypothetical scenario. An investor currently is making $100,000 per year. So we're talking around, $8,000 to $8,500 gross monthly income. This investor have $200,000 of cash he or she wished to leverage to get financing to purchase up to 10 properties. And this investor wished to retire in 5 years. What does that mean? That means he or she would like to, or even this couple for that matter, would like to use the real estate cash flow, use the real estate passive income to totally or virtually almost totally replace his working income, meaning he can walk away from his $100,000 salary anytime, any day, and just retire and go through whatever he or she wish to do with the $8,000 of real estate passive income. In fact, free and clear, using the real estate cash flow, using the portfolio of the 10 properties to sustain this person's life forever. Okay. So without further ado, and of course, Richard Advani, being an investment loan that he is, he will clearly share with me as I go through the examples. So we're gonna, talk among each other about the as we go through this. All right. So Richard, are you ready to help me to present this?
Absolutely.
Perfect. So right now, I'm going to share this screen. If we all can see. Although I'm going to use this property in Buffalo, Niagara Falls, I mean, investors can buy any kind of property such as this in anywhere in the Midwest, if you will. And Richard, he know what I'm talking about. So this is the real properties that, so the idea is an investor go through a loan pre-approval, hopefully with Mr. Advani, and then assuming he or she qualifies, then this person will have a wish to meet the goal that I set, and by buying 10 of these duplexes, obviously using their Fannie Mae lending guideline, right? Each person have the ability to qualify for a maximum of 10 Fannie Mae lending guideline, in this particular case, using 25% down payment. So let me go over this number one time. All right, so this duplex is although it's located in Niagara Falls, but investors can buy, I would think so, this type of properties, in many areas in the Midwest, and I'm not going to cover that because my network does not represent any other Midwest area. So the only one area that we represent, which is typical Midwest type of properties, are here in Buffalo, Niagara Falls. So I'm not here to promote Buffalo, Niagara Falls. I'm just going to go over the big picture as to how somebody can achieve their retirement dream using the formula, using the goals that I just discussed. So this property is this duplex is $76,500. Is all rehab and all is turnkey, have property management, and the tenants are in place. Both of the tenants on 2 doors. So purchase price $76,500. And because of the duplex or higher, investor have to put down 25% down payment. So the total out of pocket, including closing costs, is approximately $23,000. But for the sake of our discussion, let's say $20,000 per property. Total out of pocket money for the down payment and closing costs. And the estimated rent, typically on this property, is around $1,300. You know, $650 on each door, $1,300. Then I put down the vacancy factor, which is 2% vacancy factor on an annual basis. Then you have the property, the debt obligations, the monthly tax, 162, insurance 83, property management fee at 10%, $127 per month. So equals the operating expenses 522. The 25% down payment, the mortgage is the loan amount is $57,000, and then the monthly mortgage is $258. And then at the end of the day, being that the $1,300 monthly gross monthly rent minus all the debt obligations, and the end result is in this particular case scenario, the investor will achieve approximately $493 monthly net cash flow. All right, everybody get this foundation, what we're going to talk about. So again, with the $200,000 cash this investor has, we just do the simple math, right? I mean, so therefore, this investor will purchase 10 of these duplexes. It doesn't have to be duplex, right? I mean, if you can find another property somewhere in the Midwest, a single family home rental for $76,500, if you can find a $1,300 rent, by all means, feel free to do that. But this is just a hypothetical retirement scenario, right? So since the monthly net cash flow is $493, so let's, for the sake of discussion, the monthly cash flow net is $500. All right, hold on, I gotta sneeze. I think so. Excuse me. So
bless you.
Thank you, Richard. So, given the scenario, and you've done many of these loans to our investors, not only in Buffalo Niagara Falls, but in all over Florida and Texas and a few other places for a number of years now. So a client come to you on our situation right now. You've done the loan pre-approval. So in fact, we have several cases already in the past few years where some of our investors have done almost exactly what I'm about to share you. So Richard, so with these 10 properties, given this loan scenario, can an investor buy, of course, we all know an investor can go buy one property at a time using your loan, using your investment loan, closed escrow, whatever. Tell me a situation, if you find a investor that are very ambitious, very courageous, they want to this 10 property goal, can an investor buy, okay, I'm gonna give you a very ambitious question. Can an investor get the 10 mortgages all at one time, or 5 mortgages, whatever, all at one time? I mean, is that even possible? Tell me, as a loan agent.
Yeah, that's definitely possible. We close many transactions for clients where they're buying 4, 5, 6, 8, 10 different transactions at one time. So yeah, that's something we can absolutely assist with. If someone is entering retirement and they want to buy 10 of these at once, we can absolutely help with that all concurrently. Yes.
Wow. Does all lender does that, or you, because your loan company specializes in investment loans, you have the ability with your underwriter to do this kind of 5 or 10 mortgages all at one time? Tell me, I mean, what is your capacity versus other lenders that may or may not have this capacity?
It just depends. I mean, there's probably 3 or 4 in particular loan officers across the country that I know of that really specialize in working with investors. So I'm sure a lot of them are very comfortable with multiple concurrent transactions, but most lenders aren't. I get a lot of clients referred over to me where their lender told them they have to do one or two or three at a time. We do have the more unique ability, I guess, to use projected rental income on the properties that they're buying, or even to use the rental income the property generating, where a lot of other lenders can't use rental income right away, or at least don't think they can. They don't know any better. So they may advise people differently in terms of closing a bunch of deals at the same time.
Yep. As a matter of fact, Richard, you have done several of my clients. They did not necessarily bought 10 properties all at one time, but they have bought 3, 4, 5 all at once. You remember, I don't know, well, you do so many loans for investors, you may have forgotten about several of my investors actually have done this, not to the extent of 10 mortgages all at one time, or even 10 mortgages within the first 5 months, but they have done 4 or 5 or 6 of these, or almost concurrently in the past. But either here or there. So, all right. So let's assume this investor, they're doing 5 mortgages. They're buying 5 of these duplexes. Because since you know Buffalo and Niagara Falls very well, you know our turnkey provider very well. This market was able to get an appraisal properly based on your loan underwriting, so you're not subject to any kind of challenges with appraisal. Whereas in other Midwest properties, I don't know who they are, but at times, the seller or the turnkey provider at other locations, they overprice some of the properties to investor, and then when your investor do the loan, then the appraiser didn't match the purchase price, so the investors becomes angry. The investors come out of pocket to cover the appraised price, so make it not a happy experience. But you are different. You are able to make this happen because you know the each local market in many different areas of the country. Am I right, Richard? You and your company?
Yeah, definitely. I mean, not only do I have owned or own properties in most of the markets you work with. Obviously, we close tons of transactions in those markets, so we are able to close a little more seamlessly, I'd say, than other lenders.
Yep, sounds good. Okay, here we go. All right, so let's assume the investor closed of these 10 different duplexes using 10 different mortgages in next, let's say the next 3 to 6 months, right? Done, everything's done. Look at the numbers, which is mind-boggling. A lot of investors are not aware that this type of financial freedom strategies are available. But since I've done this for so long, I always find different way to help our investors to achieve their retirement goals. So think about it, around 20 grand each, just by using leverage. Okay, I mean the debt will Richard know more than anybody else, being in this business. I mean, if you know how to leverage your debt, meaning the mortgages, you can really use real estate to your max advantage. But that's another day. We can discuss that between Richard and I. So per one transaction, all the investors have to come out with a little bit more than $20,000 to buy one property, one duplex. I mean, we're talking $1,300 rent on a purchase price only $76,000. We're talking the rent to value ratio of 1.7%, which is off the chart, right? It's way above the benchmark for real estate investment of homes. Then the capitalization rate is a whopping 11.8%. Is very high. Look, Richard and I know what the capitalization rate means, but again, we're gonna at different time we'll educate our investors. What is a rent to value ratio? What is a capitalization rate? What is a cash on cash return? We will have another presentation for that, right, Richard, in a future podcast. But knowing that the rent to value ratio in this type of property is 1.7, which is amazing. Capitalization rate 11.8%. Cash on cash return is a whopping 26%. And the total return, by the way, even the some Midwest markets are also, believe it or not, their market is also appreciating, not just the hot markets that we've been accustomed to hearing in the last few years, like Florida, Texas, whatever. Even the Midwest market, even but for Niagara Falls, their houses going up in value, mainly due to low inventory, high demands and record low interest rate. We all get that, right? So I projected 5% appreciation rate in this Buffalo Niagara Falls market. So you add that to the annual net cash flow of almost $6,000 in this example, and then the 5% appreciation, and then the principal reduction. Then the gross equity income in this case is almost 11,000, right? You divide 11,000 into the total down payment of 23,000. You have a first year, the end of the first year, total return on investment of a whopping 47%. Where else in the stock market you can get any kind of return similar to this? You don't even need to answer that question out there. Nothing beats real estate investing, no matter how you spend it. I don't care who you are. I don't care if you're a stock market guru or an expert, whatever. You cannot match real estate investing for a long-term basis or historical return. Real estate is one of the most multi-dimensional, most highly lucrative investment assets in the world. Right, Richard?
Yeah, I mean, and on top of that, once you factor in depreciation, real estate allows you to create tax-free income, which is amazing. And then, what a lot of people fail to realize is real estate allows you to do leverage. And leverage is what really makes you be able to absolutely smash any stock market return earnings you could make. Because, in the stock market, if you want to buy $300,000 worth of Apple, you need to spend $300,000 generally to buy that stock of Apple. Whereas in the real estate world, you can buy $300,000 worth of real estate for just $60,000. So once you think of that, I mean, you can buy 5 properties worth 1.5 million for the same amount of 300 stock that you can get for $300,000. So once you actually look at that, the amount of return that you get for the cash deployed is absolutely much higher with real estate versus the stock market. And that's not just my opinion or SeeWing's opinion, that is statistics.
Yep, that's right. It has been proven over time for many, many years. So let's continue. Let's finish up on this financial plan, if you will. So after 10 houses are being purchased within a mere 6 months, this investor have a portfolio of 10 mortgages. Each property of this duplex are triggering almost $500 per month net monthly passive income. Net. So $500 multiplied by 10 properties. What is that amount? $5,000 monthly net positive cash flow, assuming, by the way, the numbers I put in here, I factor in 2% vacancy factor, I factor in 7% maintenance, right? So I'm trying to numerically make this pro forma, this cash flow analysis in front of you as realistic as possible, all right? So I'm not sugarcoating anything. I'm not over exaggerating anything, all right? These numbers are based on realistic past results. But then again, past results are no indication of future performance. We all know that, right? This is just a theoretical example, but it's a reality. Our investors have done it. I have done it. Many investors have done it that I worked with over the past 15 years, what have you. So $500 per month times 10 properties, 5,000. These investors can even retire within 6 months from today. No, wait, but there's more. Sounds like an infomercial. $5,000, that's not enough, okay? Because this investor is not ready to retire until 5 years. You know what's the next strategy? And Richard, you don't know what I'm about to say, but you're gonna agree with me. So I'm gonna use the payoff debt strategy, which I teach in class on my educating classes in the past. So, what I'm going to do, this $5,000, the monthly net cash flow for these 10 properties, I'm going to, this investor will accelerate the loan. This 30-year mortgage, you know how you can pay off the 30-year mortgages? You pay one extra principal of the loan above and beyond the regular monthly payment someone is making. And that way, on a 30-year mortgage, if you pay one extra principal per year, how many years it takes to pay off a 30-year mortgage? Richard, since you are the professional loan agent, you can easily answer my question. One extra principal per year on a 30-year mortgage, approximately how many years this mortgage will be paid off instead of 30 years?
Generally, making one extra payment per year knocks about 4 to 5 years off of the mortgage. And that's, one extra payment per year. So it's not a lot, but it takes off a huge amount off of the overall term.
Yeah, so that will, that could, I mean, I'm just guessing it'll take maybe by paying one extra principal on a 30-year mortgage, perhaps in about 12 or 13 years, you can pay it off the loan, right? Okay, now I'm gonna carry you one step further, your audience out there. I'm gonna pay it off, I'm gonna pay off more. So this $5,000 of monthly net cash flow, right? You know what I'm gonna do? I'm gonna have this investor to apply this $5,000 of monthly passive income and pay off one, accelerate the mortgage one investment property at a time. So in this case, the loan amount in this one property is $57,000, right? So the investor is going to use $5,000 total net passive income from 10 mortgages to pay down one property at a time, pay down the principal. $5,000 paid extra principal into one of this duplex. So 5,000 divided by 57,000. So it'll take you how many months to pay off this one mortgage? 10 months, right? Am I right? Around 10 months. Let's say a year. Okay, Richard, are you agree with me? Okay, so take almost a year to have this $5,000 of monthly net cash flow from 10 houses, 10 to pay off this one mortgage. So the first mortgage after 1 year is paid off totally. So this mortgage, no need, the investor no longer having to pay this $258 of a mortgage, right? So by paying off the first mortgage, first rental property, this $258 will be add on to the $5,000 of existing monthly passive income, right? So instead, the investor will focus on $5,258 to focus on a second property and lump sum paid off this $5,200, $5,300 into the actual principal per month, and will pay it off the second mortgage in another, let's say 6 to 7 months, right? So after 6 to 7 months later, the total mortgage of a second property is paid off. Then by not having any more mortgage payment, you're gonna apply to pay down the third property. So you get the idea. I'm not gonna go over all 10 properties, right? The idea is it'll take maybe, Richard, from a high level, do you agree with me? If you're gonna use this domino effect, use this payoff strategy in about 5 more years, would you agree that all these 10 mortgages will be totally paid off, will be no more mortgage payments on these 10 houses, right?
Yeah, based on what you've run, that looks right, yeah.
So, so we're talking, if it takes 6 months to buy these 10 properties, it takes another 5 years using the debt payoff strategy as I described. So instead of having $5,000 monthly mortgage, you multiply the 258 times 10 properties, $2,580. So 5,000 plus $2,600, we're talking 7,600, let's say 8,000, right? So $8,000 of monthly net passive income this investor has, right? In about 5 years. So you can retire debt-free. So at the end of the day, all this someone needs is around a mere $200,000 of cash. I know a lot of people may not have $200,000 of cash, but then again, Richard and I knows a lot of people have $200,000 of cash because we work with many, motivated risk investors that have this kind of money, especially when most of our investors are located in California. So really think about it. Okay, all this big picture is with $8,000 of monthly net income, no more debt. All the 10 mortgages, all the 10 duplexes are free and clear. You can you not use the 8,500 or whatever money available and then kiss your job goodbye, replace that paycheck, totally retire in 5 years. So you could be age 30 today. If you have this kind of financial goal, which we described, you can retire age 35. If you are age, for example, age 60, and you have done, let's say you have done nothing for the past 40 years for whatever reason, you as any investor out there, if you have no 401k, no savings, no IRAs, no retirement, all you have is $200,000 of cash, and you have good credit that you can get loans. You can make up all those years of lost time, which for whatever reason, you guys out there, you have not, you really are really behind the eight balls in terms of retirement. You can catch up. You could apply this 5-year goal and retire with $8,000 monthly net income for the rest of your life and keep your 10 properties forever. Yes, you have to deal with maintenance and vacancy and all that. By the way, I have not even mentioned all the equity growth that may have achieved from these 10 properties over time. That is not even into my calculation. So at the end of the day, today you make 100 grand, you have $200,000 of cash. In 5 years, you have $8,500 of monthly net income. That's it. I mean, that's your financial freedom goal. So I'm done with my presentation. So Richard, by the way, when an investor, by the way, since you do this kind of loans, when an investor wish to apply the extra payment into a particular mortgage, what are some of the administrative instructions that investor have to notify the lender that's holding mortgages that this investor desire to apply one extra principal into the loan? What kind of what they have to do?
I would, if they're planning on doing it intermittently, I would firstly make your regular scheduled monthly payment, and then a day later make the additional principal payment. But it's probably a good idea also to call the lender and let them know, hey, we made an additional payment and we want it to be applied towards principal versus towards the next month.
Yeah. So how does the investor maintain the the monthly changes of the mortgages? I mean, does the lender have any kind of way to using some kind of calculator or some kind of software you can track the decreasing principal loan balance over time? I mean, yeah, is there a way? Is there a software, or does the lender these days have the technology to allow the investor to track their principal reduction? As the debt reduction strategy is being put in place?
Unfortunately, no. That's something they would need to track on their own.
Yeah. Okay. So, but have you seen, Richard? Have you seen some of your investors that did the loans with you have done any kind of a debt acceleration, but playing actual principal on the loans and have
Yeah,
having
I
good
think
discussion?
really do. Yeah.
Mhm. Okay. All right. So, okay, I think before we conclude on this formula, so what do you think, Richard? Do you think this is one of the good? I know this is not the only retirement strategy used in real estate, but it could be one of your strategy, right? Everybody's situation is different. So, yeah. So, Richard, you have any kind of last minute thoughts about these type of uh, formulas and retirement strategies?
No, just that obviously rental real estate's great, but you're going to need to execute differently depending on your individual strategy. A lot of our investors are in their 40s right now and aren't necessarily looking to, capitalize on the monthly aspect of the cash flow. So most of them are sending in those extra payments to the mortgage to pay them off quicker. That way, when they are 60 or 65, 15, 20 years from now, and when they do need the income, the properties are actually going to be generating, be paid off and generating a substantial amount of money. Whereas on the other hand, if you're 62 right now and you plan on retiring in 2 years, then the monthly cash flow probably means a little more and you won't be sending in the extra, right? Because you need that income. But in the scenario SeeWing mentioned, if you're 15 years away from retirement right now, now's a great time to buy real estate because you don't need the monthly income. So you can apply that monthly income towards paying off the loans quicker. That way, instead of holding on to $300 or $400 a month right now, which is great, 15 years from now, when the property's paid off, you're holding on to 15 or 1600 a month, and once you have 10 or 15 properties, of course, you could do the math. That ends up being quite a bit of income. And it makes it a lot easier to replace your job income. Plus, the big thing to keep in mind is, given that you have depreciation to help offset some of those gains, you really don't need to make as much as you're making now gross, because as we all know, if you're making $100,000 a year, only about 55 to 60 of that actually sees your pocket. Whereas with real estate, if you're making, 60,000 or the 65,000 a year in rental income, and you're offsetting that with depreciation, you're really going to see that whole 60,000. So, 60,000 in real estate income is just like 100,000, 105,000 in income from your job.
Right.
But
absolutely. Yeah. Mm-hmm. Yeah, exactly, Richard. So again, I mean, we each real estate investor need to surround themselves with a team of financial professionals. As you going through this kind of journey, you need to hire a tax advisor that understand real estate. You need to hire a attorney that understand asset protection and whatever. You need to hire a really good investment loan agent, such as my esteemed guest, Mr. Richard Avani here. You need to hire someone that understand your real estate goals, that that can talk the talk, that have a real estate experience, because not all financial professionals understand real estate investing. You'd be shocked, you'd be surprised about what's going on. So we have a network of financial professionals that we work together, and Richard, as an investment loan agent, is one very big part of my team in helping you investors out there to achieve your goals. So, okay, so that's all the time I have. That's all the time Richard has. Richard is so busy doing investment loans. He has a very good staff helping him to do a lot of loans for investors from all over the country. So thank you, Richard, for your knowledge and perspective and advice and perspective. So that's it. Thank you for attending, Richard Avani, and we will do some other future podcasts like we have been consistently on a weekly basis. So thank you so much, everyone out there. Thank you for attending. Good luck in your financial freedom goals using real estate. Thank you so much, guys.
Thank you.
All right.